We're just a few weeks into 2026, and something extraordinary is happening. Silver, a metal many had left for dead, has been on an absolute tear, smashing through old records and briefly touching over $93 an ounce. For a few frantic days, it seemed poised to clear the mythical $100 barrier. Then, just as quickly, it pulled back, shaking out the latecomers. Today, it's hovering around $90. But what if that violent price swing wasn't the final move? What if it was just a tremor before the real earthquake? For the past 5 years, a silent deficit has been draining the world's physical silver, and the breaking point is now imminent. While most are watching the daily price, they're missing the two fundamental forces set to collide in 2026, pushing silver well into triple-digit territory and triggering a crisis no one is prepared for. This isn't just a story about a commodity, it's about the intersection of technology, global power, and the future of money itself. What's coming will affect everything from your energy bills to your retirement savings, and it's happening faster than anyone thinks. Section 1. The problem, the silent deficit. To understand where we're going, you have to understand the secret the silver market has been hiding in plain sight. It's called a structural supply deficit. Put simply, since 2021, the world has been consuming far more silver than all the mines on Earth can produce. And this isn't a one-off event. It's been happening year after year. By the end of 2025, this relentless consumption is estimated to have created a cumulative shortfall of nearly 820 million ounces. To put that into perspective, that's almost the entire planet's annual mining output. Imagine if, for a full year, every single silver mine on Earth shut down. That's the scale of the hole we're talking about. So the obvious question is, if we've been using more silver than we mine, where has it all come from? The answer is, we've been raiding the world's savings account. For years, massive, visible inventories of silver, held in vaults in places like London and at the COMEX in New York, acted as a buffer. When industry needed more metal, they simply drew down these stockpiles. But you can only do that for so long before the savings account runs dry. And that is exactly what we've been seeing. Throughout 2024 and 2025, we witnessed a historic draining of these inventories. Warehouses in London saw huge outflows to meet ravenous demand, particularly from Asia. The Shanghai Exchange saw its stockpiles plunge, and at the COMEX in New York, the all-important registered category, silver available for immediate delivery, has been dramatically depleted from its peak. These aren't just numbers on a screen. This is physical metal, the last line of defense vanishing. For 5 years, the market papered over this problem. As long as there was a bar in a vault somewhere, the price could stay disconnected from physical reality. But that buffer is now dangerously thin. The system is stretched to its breaking point. This is the ticking bomb under everything, and that surge to over $90 is the sound of the fuse getting dangerously short. The market is fragile, hollowed out, and completely unprepared for the two shocks that are now hitting it at once. Section 2. The agitation, the unstoppable demand engine. The deficit alone is a huge problem, but what turns it into a crisis is the kind of demand that caused it. This isn't optional, speculative demand. This is inelastic, non-negotiable industrial demand from the most important technological revolutions of our time. Today, over half of all silver consumed is for industrial use, a figure that hit a record of over 680 million ounces in 2024. Let's break down the 3 engines driving this unstoppable consumption. First, the green energy revolution. Solar panel manufacturing has become one of the single largest consumers of silver. Silver paste is essential for its unmatched electrical conductivity, and as the world races to build out solar capacity, demand has been explosive. Silver demand for photovoltaics, or PV, nearly quadrupled between 2013 and today. Projections show that solar alone could eat up 20% of all silver demand by 2030. Second, the electrification of everything. Every electric vehicle contains significantly more silver than a gas-powered car. Some estimates say between 67 and 79% more. It's in battery contacts, power inverters, and countless electrical connections. The auto industry's silver demand is growing fast, with use in EVs expected to overtake traditional cars by 2027. This isn't a trend that's going to reverse. It's a global transition, locked in by policy and consumer choice. And third, a new and powerful driver few were talking about just years ago: artificial intelligence. The AI explosion has triggered a massive build-out of power-hungry data centers worldwide. These facilities require vast amounts of high-end electronics and power management systems that all rely on silver for its reliability, adding a completely new layer of demand on an already strained market. What makes this industrial demand so powerful is that it's largely inelastic. For these industries, the cost of silver is a tiny fraction of the total cost of a solar panel or an EV. If the price of silver doubles or even triples, they don't stop buying. They need it. There are no viable, scalable substitutes for silver in most of these high-performance applications. So, unlike an investor who might sell, industrial users will pay whatever it takes to keep production lines running.
Now, to be fair, at these record prices, some companies are researching ways to use less silver or substitute it with cheaper metals like copper. But that process is difficult, expensive, and takes years to implement at scale without sacrificing efficiency. For the foreseeable future, the momentum from solar, EVs, and AI continues to overwhelm the market's ability to supply it. This is the engine that has pushed the market to the edge, and it's the backdrop for the two great shocks now arriving. We're about to reveal the two shocks that are turning this critical situation into a full-blown crisis. The information we're sharing comes from connecting dots that mainstream finance often ignores. If you want analysis that looks beyond the daily headlines to understand the powerful forces shaping your financial future, take a moment to subscribe and click the notification bell. You won't want to miss our next investigation. Now, let's get to the catalysts.
Section 3. The Revelation. The Two Shocks Colliding. A 5-year deficit and unstoppable industrial demand set the stage. They created the fragility. But it takes a catalyst, a shock, to turn fragility into a crisis. In 2026, we're not just getting one shock, we're getting two, hitting the market from opposite sides, one from supply and one from demand. Shock number 1, the weaponization of silver. For decades, we've treated silver like any other globally traded commodity. That era is over. We are entering a new age of resource nationalism, where countries see the metals they possess not as goods to be sold, but as strategic assets to be controlled. The most significant move happened in late 2025, when the United States officially added silver to its list of critical minerals. This isn't just a title. This designation legally reframes silver as a material essential for economic and national security. It puts silver in the same category as lithium and cobalt, metals vital for defense, the energy grid, and high-tech industry. This legally mandates that the U.S. government focus on securing its own supply chains. But the U.S. isn't alone. The most impactful move of all came on January 1, 2026, when China, the world's refining powerhouse, implemented stricter export controls for silver. While not an outright ban, it's a clear signal. China intends to prioritize its own massive industrial needs. Some analysts see this as weaponizing their control over refined silver, giving them the power to restrict the flow of metal to the rest